Well, the roller coaster, better known as the Chinese stock market, simply rolls on. Are the massive losses that we have seen in the past 30 days over, or is it a buying opportunity in a market that is actually still up pretty good over the past year? It's a good question. Let's ask the Trading Nation team. We've got Craig Johnson of Piper Jaffray. We've got Curtis Holden of Tanglewood Wealth Management. Craig, got a really interesting chart that is scaring, I no doubt will scare some people, which is the Chinese market compared to the Dow Jones Industrial Average in a very fateful year of 1929. Why are we looking at this?
Sure, Brian, thanks. And so a couple things here. Well, the reason we're looking at this kind of chart is we are seeing some similarities to what we had seen in the Dow, where you had a very parabolic advance and then a sharp correction back and a relief rally, and then ultimately you saw a typical parabolic advance correct down even further. Now, if you reel in and you look specifically at this year, it's very interesting from a technical perspective. Sharp advance up, have this correction off about 30 and change percent, right back to the 200-day moving average. You look at the price action here today on Friday, and you can see we're having a very nice relief rally. All the traders are watching this relief rally here to see how far this is going to follow through. But those that have studied charts and looked at charts for a long time know that parabolic advances typically end poorly. And typically you get about 110% retracement of the entire advance up. So if that is the case, that would be setting up a chart that could be similar to what you had seen with the Dow back in 1929. But I want to remind people, may not play out exactly that way from the standpoint that that is not China is not as much of a free economy as what you had seen in the U.S. So one consideration there to think about.
Yeah, and another, Curtis,
but an interesting similar.
It is, and it certainly is a scary one. You know, some people will say causation and correlation may be different things, but Curtis, you know, the U.S. investor cannot buy domestic Chinese stock and buy the Hang Seng listed shares, the H shares, or you need a very specialized local agent to buy the domestic stock market. So as a wealth manager, how concerned are you about the correlation that Craig just brought up, or about China in general?
Well, we're concerned about China in general. We're not doing a lot of, or not really doing any direct investing there right now, and we'd encourage investors to be cautious about doing a lot of investing in China right now. We're concerned about all the debt that they've taken on in recent years. If you look how much they've added in the last 5 years, it's been pretty massive. That concerns us. They're also struggling with overcapacity, and they haven't made the transition that many had hoped they would make towards a more consumer-oriented economy. And so we would tell investors right now to focus more on the developed markets, and to kind of sit tight and wait and see what happens in China. But longer term, you still want to keep an eye, because we think if they get the proper reforms in place, that you could see a return to some stronger growth there eventually.
All right, Curtis, it was a real pleasure. Thank you very much. Concerned about China now. Craig, yeah, your chart, I think, speaks for itself. Scary looking chart that many no doubt hope do not actually mirror each other over the longer term. Craig and Curtis, thank you very much. And folks, thank you as always for tuning in to Trading Nation. I'm Brian Sullivan, and we will see you next time. Take care.